All right, welcome everyone. So today's topic is about portfolio forex investing slash trading, or traditionally we call it as a basket trading. Now we has been talking about this topic since 2021 until now, and today I would like to bring back up this topic. So in case that some of you that have been joined at the very early stage, you might have heard about this strategy before, and now I have further simplified this strategy so that everyone can do it by themselves. By the end of the sessions, you will be able to understand that why we are doing a basket of trading. What is a basket of trading? And why we are doing a basket of trading, sort of like a portfolios, uh, a group of markets that we trade all together. When we want to buy, we buy all together. We want to sell, we sell all together. Now, why we are doing it and what is the purpose of doing it? These are the topics that we are going to cover for today. But today's topics will involve a little bit of programming language, but don't worry about that because ChatGPT AI can solve most of the problem. The most important thing that we have to do is to understand the logic behind and how can you come up with your own portfolio of tradings, and that can potentially make your trading returns much more smooth. So let's have a bit of background understanding. Now, we focus specifically for forex, but this method itself do apply not just for forex but also for stocks, commodity like gold, and regardless of which market, including crypto as well. Regardless of which market that you are trading, you will always find that people are doing accumulated, or we call it a portfolio market. I give a most basic example. So in stocks market, I believe that you understand stocks you can trade individually, meaning that you can invest into a single share or you can invest a group of share. A very common example is in the US, there is a Apple share, but you also worry that buying Apple share could have the risk of up and down. Hence, you invest into S&P 500, which is a collection of multiple shares in a certain specific ratio, and that potentially can give you much better returns versus the drawdown. So the idea is like this: if you are trading on a single market, right, what are the risks that you're exposing to? Wait, On a single market, the risk that you're exposing is a single market up and down, correct? And it could be the worst time that you buy at here, and then the market comes all the way down. Even though the market may goes up, but you encounter a long period of drawdown. That is the downside of a single market. But what can we do to make sure that our returns is more like a smooth upward curve? Well, that is by multiple or a group of share to do it. So the idea is like this: logic, if a single market fluctuate in such a way, up, down, up, down, up, down, up, okay, can we find another market that is moving in such a behavior whereby when this market up, this market down, and when this market down, okay, when this market down, I up, down, up, down, up. Okay, you guys see what I mean? Meaning that when A market is going upwards, B market will be coming downwards. Okay, and vice versa. This down, this up. In this most extreme case, what we are going to do is that we take A plus B together, we form a C. C is actually a portfolio between A and B. And when we plus these two together, the result is going to be something like this. Okay, because this plus this equal to this. This plus this equal to up a bit. This plus this up a bit, up a bit, up a bit. Now our return, instead of up, down, up, down, up, down, that's fluctuating so much, we are minimizing the fluctuation and also at the same time smooth out the curve. Okay, we smooth out the curve. And by doing this, is also helping us to mitigate market uncertainty, or more specifically for Forex, we call it as for mitigate market manipulations. For example, we, we understand that share market can be manipulated, and that is also goes to Forex. Forex can be manipulated as well. For example, USD, who can manipulate it? Yes, only the Federal Reserve likely they can manipulate, which is US government. They say, okay, I need to increase the rate. They manipulate the fluctuation so they can spike up the price as well. A single spikes in that particular market, the other market doesn't move, right? This is what we call this as manipulation. And this is the risk that when you trade on a single market. So when you make a buy, you may be profit. But if you make a sell, they manipulate all the way up, you will be losing a lot. But if you combine A plus B together, you buy a small portion of B and a small portion of A, even there is a sudden manipulation, what will happen to your portfolio is only it will affect a little bit increment. Okay, actual market with one single trade will have affected by big market movement. A portfolio market manipulation will only shift a little bit, which will not affecting a portfolio a lot. And hence you can able to expect your returns compared to other people is being much more smooth in doing it. Okay, so that is we call it as the logic and the theory behind. And let's just put it another way. Okay, if there's a sign, I mean, if there is a wave like this, market move up and down like this, you just need to find another market that is moving like this. Okay, when you add up this together, then your whole market becomes flattened. Now, let's take some actual case studies so that you can have a better picture. Now, over here, what you can see is that conventionally, right, when we do tradings, it's single market, okay? But then when we actually combine multiple market together, what will happen is that, for an example, so this is one of the combination of the market. Okay, so there are a lot combination of the market nowadays. Okay. Something wrong. Okay, never mind. Okay, so this is one of a few example. If you are trading a single Euro AUD, okay, how does Euro AUD looks like? This is Euro AUD on a daily chart. Now, on a single Euro AUD, if you want to buy, you can buy here, and it goes all the way up, then it's stagnant. It does not move anyway. It's not so good for investing because it does not continue to go up. It's also not good for trading because it's stagnant. Right? In trading, what we need is volatility. Same goes to GBP and ZD. GBP and ZD. This is GBP and ZD. Well, this market is good, up and down, but the fluctuation is not so stable. Sudden up a lot, sudden down a lot, and we thought that it will continue down, but it spiked. It's confusing. Next, AUD and ZD. Now, this market was good. There is a spikes up and down. It's still moving, but it's a bit hard to catch where there will be having a reversal, because from what we can see is that it had up down, but it can down for a long time, up for some time. Now we see that different markets have different behavior. So what we do is that we take a certain percentage of that particular market and we do a combination together. For example, over here, this portfolio, right, is a 3 market portfolio combination of Euro AUD at negative 8%, GBP and ZD at negative 36%, and AUD and ZD at negative 54%. Negative means sell. So here we open 3 sell trade. Okay, this portfolio is like 3 sell trade. Now, how this portfolio work is, okay, so when we wait the market to have a pullback, you can see that when market have a pullback to here, we can enter for a sell. All right. When we want to sell this entire portfolio, so what do? You just reverse it to become buy, buy, and buy. Okay. And in your MT4, you go to open add, okay, 0.0 add lot, 0.36, and 0.54 lot. When you open this combination, the entire market will be you are trading the entire market. Basically, when you're trading the entire market, it's much more easier. I can take it to see that it is more smooth. I give one more example, which already been seen in the workshops. Okay, so this is the market that is we have been found out. So when you're trading this market, right, this market itself, as you can see, is like this. Okay, a very clear insight on how to trade this market. This market is a combination of 0.78 lot of GBP-CHF, 0.76 of CHF-JPY, and goes with 0.7 of GBP-JPY. So when you actually sell the entire portfolio here, okay, when you sell the entire portfolio here, the market just go all the way down. You don't even need to concern whether that it will continue goes up or down, because the entire trend show that it will just continuously down, 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 down. Another market as another example. Okay, this market is no-brainer, whereby you can just buy the entire portfolio. It will just continue to goes up, and it's been going up, showing from 2020 all the way to right now, which is pretty good. And basically, from this kind of portfolio, right, you don't have a hustle to time the market, like when to in, when to out, when to in, and when to out. Basically, you can just put money in and then just let it grow. It is even more stable compared to market like gold, stock market, because these are the specifically calculated portfolio based on we call it as a portfolio market, a combination of market to do the tradings. Okay. Now, before I continue, so far you guys get the logic or understanding of what is basket trading or not, right? If you guys can get it, type a yes in the chat box, because on the next topic I'm going to teach you how you can come up with your own portfolio of tradings, and how can you actually be we call it as increasing your trading consistency while minimizing your trading risk, right? Type in a yes in the chat box if you already understand how this thing work. Okay, thank you so much. Now, let's moving on to the next part, which is on the Forex part. Okay. So for the Forex tradings, on the system design, how does it work? So this system have a few steps, okay, and this actually align to the robot setup. Okay, this align to the robot setup that is common. Now, how this has echo? I guess I roughly know why already. Okay, fine. Now, in order to build a bot, right? I mean, this is like building the robot from scratch already. Yeah. A portfolio of trading, if you're doing on daily time frame, that's called portfolio investing. But if you're doing on a 1 hour time frame, that's called as portfolio trading. If you put the portfolio in 1 minute time frame, seeing that which market have uptrend or downtrend, that's called portfolio investing. Okay, so let's just do it simple first. Let's do it in the daily time frame. Now, what are the process needed? First thing first, you need to find out what are the market that you need to trade. In Forex, what are the choice that you have? 28 pairs, starting with Euro, GBP, Euro, CHL, all the way to JPY. Okay, and 28 pairs of currency, you will form up a portfolio. Now, what does it mean by portfolio? A portfolio can be a combination of currency of 2, 3, or 4, or 5, or 6, and so on. Okay, and the combination, the choice is what we need to consider. So number one, you have a list of market and you pull the data first. Where can you pull from? You can pull from MT4, 5, or you can put it from TradingView, or more professionally people are taking from Yahoo Finance. Now, actually, Yahoo Finance is not a very good source of data because it is free and the data-wise is not so clean. There are a lot of other app, we call this other software that can provide high quality data, including like not necessarily Dukascopy. Okay, these are the platforms that can provide a high quality data. But if you cannot have, you can actually just download from MT4, MT5. Use the data from MT4, MT5 as a reference to your historical data. Okay, for here, I'm taking daily time frame on Forex for all 28 pairs. After that, moving on to calculate the portfolio generation part. Since I know that I need a portfolio of 3, I mean, why 3 is just for a good example. You can go for 4, 5, 6, no issue. Portfolio of 3. Okay, 3 pairs. 3 pairs into one portfolio. So I can be EU plus GU plus UJ, for example. Okay, and with this combination, I can also do something like a weightage of it. Okay, a weightage. And this particular weightage, at the earlier stage, I don't know what to put. So I just random put the number first and test how was the result. So I can do something like, I can buy 1 EU, I can buy 0.5 GU, and then sell maybe 0.8 UJ. And this for my portfolio. And with this portfolio, I use my Python to plot out the chart. Okay, when I can plot out the chart, which is I can calculate the portfolio already, what I do, I calculate the statistic metrics for this particular markets. Now, this is very important. Come to statistic. The common way that people use to analyze for the robots. Okay, basically this portfolio is equivalent to robot already, which you can just put the money in and let the market fly. Okay, you don't even need to consider what is like RSI lah, what is indicator. It's indicator free trading strategy. No need any indicator. You just need to find a market that is consistent going up. Okay, so the metric that we use is very different. Now, the metrics that have been used here is including like mean returns, the average return of the entire thing. Okay, meaning that if you put in a $10,000 here as a capital, after a certain period, how much that it have grown, which is your ROI. Okay, which is equal to this one, your mean return. Second, we want to measure that in order for you to achieve this ROI, this amount of profits, what are the market fluctuations, or we call it as a standard deviation of that particular markets. Okay, standard deviation is sort of like the up and down of the market. Okay, it could be portfolio A like this, and then portfolio B something like this. Okay, so now let me ask a question. This one ROI is 100%. This one ROI is only 10%. Okay, and this standard deviation is calculating in percentage up and down. Percentage up and down for this portfolio, the maximum wise is called it as maybe 20%. Okay, let's say lah. This one up and down is about 80%. Okay. Now my question is, Which portfolio do you think that have a lower risk? Is A or B? A is low ROI and smaller standard deviations. B is high ROI and also higher standard deviations. Okay, which one do you think that is going to be the better portfolio, A or B? Tell me in the chat box, is A or B? A is a portfolio that have 10% ROI but 20% up and down maximum volatility. Portfolio B is ROI 100% up and down volatility of 80%. Okay, so yes, it's correct. The answer goes to standard deviation. You can call this as a max drawdown as well, but this is a more better way of calculating the portfolio risk. Okay, and a lot of metric that been used is not valid here lah. Okay, later I'll show you the actual picture result so they can have a better comparison. But you basically need to know the first two is the basic. ROI is the mean returns. The standard deviation is the how much market fluctuate, the portfolio fluctuation up and down. Now, these two, skewness and kurtosis, you can read, but put it simple first, later I'll show you the picture. These two is all about how trending the market, and these two is calculate how ranging the market. Okay, now basically trending means that you can just park the money in for the whole day, for the whole years, don't do anything. It will just continue to up, or will continue to down. No move, no much changes. Okay, but half-life and ADF p-value, these two is calculated for stationary. Is how likely that the market is just up, down, up, down, up, down, up, down. Now, this is also a good market to trade because all you have to do is just buy low, sell high, buy low, sell high, buy low, sell high, buy low, sell high. And that is also another purpose of doing portfolio trading, because we just want to find the market that you either straight away goes up, don't move up and down, or you either up, down, up, down, up, down, up, down. Make the trading easy. That is the purpose of portfolio. But you need to understand that when we do portfolio, what will be the con? Okay, let's have a thought. What will be the downside of doing portfolio trading when you're trading three markets all together? The pro I've been mentioned multiple times, which is number one, reduce the risk. Number two, we call this pro. Risk you can reduce. Your result is more consistent. Okay, and also at the same time, manipulation also been lowered down. But what is the downside of doing this? Well, the downside of doing this is, number one, spread is higher. You may encounter with swap. Okay, swap may be even higher. All right, and also at the same time, complexity is there. Well, that's come to the point that whether or not would you like to take up a higher trading cost, but you can get a more consistent result, more consistent result means higher return. Higher return also means that your risk is also lower, and also in a way that you can minimize the chance that you've been manipulate the market. Okay, these two costs can be minimized by doing number one, ECN account. We call it as a very low spread account, or you can do with a spread rebate account. Now this is something new. Not say something new, but could be new to you guys, whereby every single lot that you guys trade, where is the money goes to? You are pay for a spread, and the spread goes to a portion go to IB, and a portion go to the broker. A broker is earning spread as their main income, but they are also contributing a little bit to IB, which is their marketeers, their staff, so that they can survive and they can introduce you to trade more. This is the end core system. But what if that you are, because when you are a trader, you are only this side, you are the only one that just pay for the spread. Why don't that you are the one that become IB as well? Okay, you replace the position. You say, I'm not introduced by anyone. I introduce myself to come in. Every lot that you trade, the spread, a portion of it goes to you. So you can take back your spread. Okay, you take back the money that you lost due to the spread. Second, swap. How can you minimize it? Now, been mentioned, you can do swap-free accounts. So actually, from the con side, there are ways to minimize the cost and the trading. Now, just come to complexity. Complexity, of course, based on this mathematics, you want to adjust number bit by bit for all 28 pairs is impossible. And that's why you need the help of robots to automatically scan through all of the possible markets and just direct tell, okay, this one can buy, this one cannot buy, sell, buy, sell, buy, sell, buy, sell accordingly. That will make the trading much more easier to proceed. Okay, for this kind of strategy. That's why we need a programming skill for this. Not say programming skill, logical understanding and logical thinking. Then you tell the ChatGPT to code for you. Now let's move on to the assessment risk. Now, just now, okay, over here, we've been mentioned that these two standard deviations and also mean return. Now, the basic, what we can do is we combine these two together and form something that we call a risk score. This is a scoring that we quantify for ourselves. For example, maybe you are the person that more emphasize on drawdowns. So you can adjust a little bit. When drawdown, I would like to be below a certain percentage. Mean below the profit must be above a certain percent. Okay, then we find the portfolio. And then we find out that what are the portfolio that is within our risk profile. Then we visualize the risk profile. And if it's good, then we save it into a CSV file. Okay, so let me just repeat again the flow of the process. Number one, you need to have historical data. Okay, and this historical data include all market from Euro all the way to JPY. For each of the market, we take out into combination A, combination B, C, D, E, F, G, and that form our portfolio. For each portfolio, we calculate their metrics. How well that this particular market combination good or not good. And basically, from here, we can verify whether or not each of these portfolio is it meet our KPI or not. Is it meet our target? So maybe this meet, this does not, this meet, no, and etc. And based on all this portfolio, we take it up and combine to another Excel table. We call this as opportunity. All these market have opportunity to trade, and then we sort it again in terms of the risk. What are the portfolio that we would like to trade? And if this is good, then we straight away buy. Okay. By using this method, right, you can totally skip off the need of analyze the indicator, monitor the chart, whatever. Because all you need to do, as long as the market portfolios meet a certain return or drawdowns, I mean, that is particularly your robot you can start to use to trade already. Okay, so far this part, is it clear to understand? Okay, if it's clear, I can type a yes into the chat box. Okay, all good. Now, let's just define a little bit of the workflow of the program. Okay. Now, the workflow of the program is basically just replicate what is mentioned above, but it's more specifically taught toward the programmers. Now, this is very important. You need to have this simplified workflow so that when you actually communicate with the programmers, freelancers to do the code for you, right? You need to be specific, telling them that, hey, what particular this is for, what are the features that I need. Okay, so the feature that I need is number one, I need to key in the inputs. What time frame to use? What are the duration of the market to analyze? How many currency pair as a portfolio and output to where? Send to who? And then where to collect the data? How to generate the portfolio, roughly in which methods? And then when we analyze what are the metrics that we reference to, right, which is statistic metrics, we do the risk assessment for each of the portfolio. And once we filter out the risk, we finalize that which are the potential opportunity for us. Now, opportunity, we can set a few threshold. For example, ROI above a certain level, drop level, it is proven long term to be uptrend, etc. Finally, it is important to visualize the output. Now, by visualize output, it is just plotting it into a chart so that you can see does the calculations versus the actual, is it match or not? Okay, I'm seeing that my side is a little bit lagging. Is everything okay? We're just testing. Okay, if it's okay, can you guys type a 1 into the chat box? Just let me know. Okay, all good. Now, overall, this is the purpose of the program. Basically, I would like to write a Python code, and in this Python code, it will collect all the markets, find a combination, and tell me which one can trade. Okay. Now, I skip all the boring writing lah. Basically, all this writing you can GPT it up. Let's come to the program design. This part may get a little bit headache, but basically, whatever the thing that you get here, you just throw into ChatGPT, tell it that write a code for me. Okay, when you can write a code for you, this is basically the result that you will come out. One time cannot success, do it 2 times. 2 times cannot, do it 3 times. I will suggest to do it in Python because it is more popular for machine learning as well as statistical analysis. In this example, I'm not yet going into machine learning yet. Okay, we just at the random analysis first. Now, there are a few steps. When you write your Python code, right, the end result will look something like this. Okay, this is the whole code. It takes about not so long, right? Less than 300 lines. I can finish everything, and basically you can GPT out everything. So first of all, you import the data. Okay, these are the, we call it as library and configuration. I mean, just put it in. Next, we've set a certain settings. Now this is a default setting that I set for my accounts. My accounts by default, 1 hour. Oh, okay. By default, I should set it in daily time frame, but it's okay. What time frame to study, and how long is the duration of study, which is I study for 6 months. Currency, combination of 3. Type, I set up in broker data. Now this broker data is I would like to measure the spread, the swap, how much would it affect my current portfolio, and then output to this folder. After I set up all these configurations done, then I start to collect my data. Now my data collecting through vector BT trading view data. Now what is vector BT? In case that you guys would really interested to go with algorithm tradings, we call it as programming style tradings. There is one, we call it as libraries in Python, or we call it a package. Or I mean, what is package? Package is like a template. Okay. Gantt chart. Have you guys used any template before? Like a Gantt chart template, meeting templates, PowerPoint templates, right? You don't need to do all the design by yourself. All you have to do is just to download other people ready-made templates, open in, and you can start edit your name. This is sort of like the template to do quantitative analysis or quantitative trading. In basic terms, robot trading lah. There is a paid version and there is a free version. I would suggest that you can try with the free version first, whereby if you feel that it's good, then you can upgrade to a paid version, where paid version have more template for you to do different style robot tradings. The reason why I would recommend Vector BT is because after studying through all the other we call it as libraries in the market, right? This template itself is giving the fastest return. We call it as fastest to process the data. In any backtest, any robots, speed is a key lah. Okay, So we import from TradingView, but you can import from Yahoo Finance as well. And another one is you can import from Alpaca. Alpaca data. Okay, here. Alpaca was one of the very popular platform whereby you can use the website here to get real-time stocks, crypto data, and including forex data as well. It's for free for certain limit, which is 200 API call per minute. 200 API call means 200 data that you request per minute, which is very sufficient. And you can use this data as a preliminary study first. Okay. But for me, I'm using more premium one, which is TradingView. My one is TradingView Premium, so I can get TradingView. Basically, I did just I get the data and store into CSV only. Okay. If you want to get the data from MT4, what you can do is that this is the MT4 chart. You can just right click. Okay. Then you can save the data into the CSV already. Now, moving on to portfolio generation. After I collect all the data, which I put all the data down, then I come to here. Okay. Over here, I can generate my portfolio, which is the combination three markets into one set of data, three pairs compared to one market, and set up a weight. Okay. Now, this weight is sort of like I randomly set first, but suppose that this weight at a higher level, you can make it into like a machine learning to come up with a result. And finally, you assign the weight into calculations. Okay. Now, what does it mean? I give an example. 0.5 EU plus maybe 1.0 GU plus, minus 0.8 USD JPY. But then, did you realize that Euro USD, the price is only 1.080 something something, okay? GU price is 1.12 something something. And USD JPY is 108.23 something. Now, the issue with this thing is that you cannot mathematically plus all of them together, right? Because the value doesn't mean anything. But what you can do is that you take the difference between each and every single one, which is 1.0810, 1.1300, and 1.0840. Okay, we take the percentage difference between each candlestick. Okay, this candlestick to the next candlestick, how much that it have grown. When we talk about percentage of changes, all market is aligned, and let's just say that, okay, rough calculation, maybe EU has been up by 1%, GU has been down by 0.5%, and UJ has been increased by 0.4%. Okay, but then this one I only buy 0.5. This one I buy 1, and this one I sell 0.8, so I minus 0.8. So what will form out? My actual portfolio increased by 5%, 0.5%, but down by 0.5, and then down further by 2.4%. So my actual portfolio down by how much? Is down by 2.4%. Okay, this is the final result. Zero. No, 0.0. This one should be 0.3%. Okay, down by 0.3%. So in the end, I only down by 0.3%. So this is what is being done. You see, initially when I trade one single market, I'm exposing to the risk of either I win this, or I lose this, or I win this. But when I combine all together, my risk is only 0.3. Okay, 0.3%. And if I can adjust this thing, the number here. Okay, the number here is this. We call it as weight. If I can adjust the weight a little bit further, what will happen is I can make this instead of negative to become a positive number. But this requires a little bit of optimization. So what we do is we're using a method called as Monte Carlo. Okay, what does it mean? Carlo. What does it mean? Later you guys can Google yourself a little bit. But in the most simple way to understand is you don't need to care what is the exact number. You just random the number until this become positive. Okay, that is the simplest way to understand. And that is the easiest way to come up with a robot as well, a portfolio. You just keep on random, just leave a computer there for 24/7. For sure, one random number, okay, until one time the random number here can get you a very, very positive portfolio. Okay. So what we do is just keep random. Every single time that we random, we calculate for all the metrics being shown here. Okay. These are the formulas, and goes through the next part is analyze the risk. Okay, we study based on standard deviations and also ADF value is how consistent in the market and how less fluctuation it is. The lesser it is, the better it is. Then go with opportunity score. Okay, if it's below a certain threshold, then I will buy or then I will use it. This is to load out the broker data for spreads, etc. Now, where do you get this Forex data CSV? The easiest way is in your MT4. You can go to your accounts. Okay, we call that account register here. In your account register here, double click. Sorry, wrong. In Alpha Illustrator, you can go to your sort downloads. Okay, in your sort download, just double click. Then you will able to get this kind of portfolio. Okay, a result of everything. And just save this into a CSV called as Forex data CSV. And that you have spread data, swap data for any use case already. Okay, then I just plot the results and I can do parallel processing as well. Now, this is a little bit of programming nerdy skill. Okay, what is this nerdy skill about? Basically, it's all about, now, let's say you have 10 portfolio that you would like to study one by one. So 10 portfolio A, B, C, D, E, F, G, H, I, J, K. 6, 7, 8, 9, 10. Let's say you have 10 portfolio. So what you can do? The normal way is you check number one. Okay, no okay, 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 no okay, no okay, no okay. Right? This is called as sequential. You check your portfolio result one by one. But this method is not so good. You can utilize what we call this as multi-processing, or we call it as parallel processing. Now, parallel processing is that instead of do all this one by one, why don't I chuck it into sections like this, this, this. Okay, I chuck it into 5 categories. Category 1, 2, 3, 4, 5. And I run 5 programs at the same time. Okay, I run 5 programs at the same time so I can check, and then check. In short, it's a programming techniques. Basically, you have one code. Okay, this is the main robots that are doing the analysis of the portfolio. There are 10 portfolio. And this 10 portfolio, instead of they do it all manually internally by them, this robot will automatically use up all your computer resources to find other robot to analyze for them. And doing this is require a CPU to do this. Okay, a better CPU. And recently, there is a more advanced techniques, which is called as parallel processing using GPU. I believe that you heard about a lot of videos talk about how the transformer model is being calculated, how the AI model right now is being calculated, right? Now that is heavily calculated on GPU. Okay, meaning that now you only have 10 portfolio, easy to check. But what if that you have hundreds, thousand, a million, a billion of portfolio? A single computer maximum only up to 34 check. You can check it 34 times. But if you want to check it further to make it even faster, then you need a GPU. A GPU can easily up to 1,000 cores or even 10,000 cores. Meaning they can chuck this into 10,000 small pieces or smaller job. Okay, something like a big task, you can chop into smaller tasks to pass to other people. GPU can do this even better. But our portfolio won't go up to a million, right? Likely just about less than 1,000 or maybe maximum 10,000 combination. Okay, and with this, after 10,000 combinations, it process, then it come out with a result. Putting all together, this is the main function. We put all the things together and come out with a result. Okay, so this is how the result looks like. Now, the Python code is very simple. It's just this bunch of line of code. Okay, and in the end, when you come out with the results, it shows here. Okay, this is in the result. This is the Python code. This is the result. Now I got two portfolio. One is a normal portfolio for everything. One is for opportunity. Okay, I open up portfolio first for you guys reference. And let's just have a detailed look. Now in the portfolio here, what you are looking at, you can see that there are a lot of markets. Okay. You can see that a lot of market inside, and also at the same time, what is their weightage? Okay. Now this weightage is referring that, now for example, Euro GBP need to have 0.37 lot, Euro AD need to have selling this amount, and then Euro NZD need to be selling at 0.41 lot, and the risk score is 0.01. Now let's just put some color so they can see better. Now let's just sort according to highest to lowest risk score. Okay, this portfolio have the lowest risk score. Okay, and let's just have a view. What if that we are saying the lower risk score? What does it mean? I think might have a little bit of problem, but just in case. By the way, is there any question that you guys would like to ask? Or so far, is it still okay? Right? You still with me, can type a 1 in the chat box. If you already lost halfway, type a 2. Right? Just be honest. If you're already lost, type a 2. And I probably can pick out a few important points and pinpoint to that way you can take out from here. Okay. Still understand still with me, can type a 1. Already lost, type a 2. Okay, already lost. Okay. So let's do like this. Now, today, the goal is that we would like to find a portfolio of market. Okay. Now, today, the goal is that instead of trading on a single market, we are trying to find out the market that can give us a very consistent upward movement of the trend. So far, this part clear. The reason why we want to get a consistent uptrend, because this particular portfolio itself, the combination of this is a robot that you don't need to do any tuning, the market will auto tune for you. And when you find this formula, this is like a secret formula to your financial success. Basically, what does it mean is when you find this, you just put your money anywhere else, it will just continue to go up. It is your own stock market. Okay. And from here, what we can do is that we need to find out the right combination of this number. You can see you have Euro CAD, you have CAD JPY, you have Euro JPY, correct? But how did you know that it's 0.33, 0.73, and 0.97? Where do you get the number from? Well, in order to get a number, the better way is that use a programming to analyze the right number. So what we do is that since we don't know what are the market that is right, to mix and match, so we just randomize everything. Same thing as what we do earlier. We randomize everything, analyze the result. If it's good, we put into a basket. If it's not good, discard, random, do again. And we do this again and again until we find the right portfolio. And here are the right portfolio. So just now I just run the program. I get a list of portfolio showing here. Okay. So I just put a simple one. These are the 20 portfolio. And in this 20 portfolio, I have different markets combined, plus together with different lot size corresponding to this account. Okay, these are the lot size corresponding to this. And moving on to the risk scoring. So over here we have the risk scoring. Basically, this defines how high risk or low risk is a particular market. Okay, for example, Euro AUD. Okay, this one. So you see, this combination is Euro AUD at a Euro AUD at -24, -24%. Yeah, this one. Okay, this one and this one is the same. You see, this number is the same. This number and this number is the same. Okay. Now, you get this kind of portfolio. Now, this kind of portfolio, the reason that why it is saying a low risk is because it's up and down at a very small range only. The maximum up and down in terms of the risk on average is only 0.112.3%. Meaning that you put in $100, okay, we say $1,000, maximum you only plus minus lose $3. A very low risk market. Up and down also move a little bit only. But what if that you are taking a very high risk market, Euro GBP at this kind of scale? Euro GBP 2%. Now, up and down is pretty much like a trending market already. Can you see this? So up and down at a risk of 2.6%. Okay, standard deviation 2.6%. Loss on how do you get the Excel file of the weightage? Okay, the weightage is we are running the Python code. Okay, this code is you get it from GPT. Okay, you get it from GPT, and you run one round, and only then you get the Excel file. Okay, and the Excel file will come together with all these pictures. This picture that you can use it for the study. Where is Excel file? Okay, Euro GBP. Let's talk about standard deviation. Okay. Okay, standard deviation, this one. And I think this one I showed already. Basically, risk score and standard deviation is about the same. Okay, because that is a formula. But let's talk a little bit other thing. Like for example, we can have skewness. Okay. So what is skewness and kurdosis? Skewness and kurdosis basically explaining how trending is the market. Okay. And we saw that the most negative skewness. Okay, have a guess lah, right? Let's just have a guess. So you think this particular market and in this kind of combinations, did you think that a negative skewness is an uptrend or downtrend? Just make a funny guess. Do you think that it's an uptrend or downtrend? A negative, a super negative skewness, uptrend or downtrend? Have a guess. Okay, the answer is uptrend. So you see, a negative skewness means that negative means a lot of downside is empty. Okay, suppose the right market should be like this. If it's skewed toward upper side, okay, and this part is empty, that means that it is skewed up and downside is negative. So meaning that a very, very negative or very, very negative skewness, it means it is referring that the particular combination is very uptrend. So all you have to do, this one you just buy accordingly. Okay, this weight time. In short, you buy GBP AUD 0.32 lot, GBP NZD 42 lot, and AUD NZD sell at 0.25 lot. When you do this combination, the market is just high chance that go up. Okay, you just can give a try in demo account. All right, just do this buy. Okay, sorry, a buy sell. Long term is going up. Same goes to this one. Euro AUD, Euro AUD point negative 2527. Yeah, this one. Okay, so this is a downtrend market. Of course, it is not very, very down because it's not yet a very negative number, a very positive number, but it is already showing a very positive downward movement market. Okay, let's just talk a little bit about half-life. Okay. Half-life. Half-life, let's just sort according to highest lowest. Euro GBP. Euro GBP 0.5. Oh, 52%. Yeah. So this is a very low ADF p-value. I record down. When ADF p-value is very, very low, typically below 0.05. Okay. When this value is below 0.05, it means that the market high chance long-term ranging. Long-term ranging, what you need to do, just draw a support and resistance, buy low, sell high. That's it. Buy low, sell high, buy low, sell high, buy low, sell high, buy low, sell high, and just repeat. This kind of market, I would say, is quite kind of easier to trade. Okay, if the AD value is very, very low, and also at the same time, the standard deviation is low as well, meaning the risk score is very high. Sorry, the risk score is very low. It's very low risk. Hence, this kind of market, you just go there, buy buy low, sell high. If you're losing money, you just continue DCA because you already know one thing for sure is the fluctuation will not be big. But what is that we are taking another one? Same Euro AUD, 30%. Okay, this one. Okay, so you see, this kind of portfolio, it is skewed upward a lot, a very, very high, a very, very high ADA value. Skewed is not up and down. Okay. Now, basically from this kind of table, right? In summary, what we can get is that the portfolio that we can just, okay, so this one we can see that it's only buy only. And this portfolio, we can do sell only. This one is ranging, so can be buy and sell. Okay. And when we're having this kind of portfolio, right? This thing, you just prepare your code, okay? Every week on Sunday, you just open up the script, run one round, you get a combination of numbers. Then you just know that on the Monday, what are the right portfolio or right setting to proceed already. Okay, that is the purpose of portfolio trading. In this case, you guys get what you guys got it already, right? You guys can got it, type a yes into the chat box, or no, type a no in the chat box. Be more specific, but anything that you guys don't understand can ask question right now. Okay. No. Okay, maybe you guys will be interested to ask question related to how to generate that particular script. But basically, the idea is that you want to generate that script, there are lots of ways. Okay, you can just copy this, the overview of the program, go to ChatGPT there, put it in, generate a Python code for me. Okay, when you do this, it come up with a code, and yeah, it do whatever the things needed. Okay, then you just need to run the code, and you will get this Excel table that can tell you what to buy and what to sell. All right, so that's basically the topics that we'd like to cover for today, and a few more things that you can consider to do on top of what I'm showing you here is number one, the data that I'm getting is only from TradingView, but most popular people are taking from Yahoo Finance. So your result and my result could be slightly different if you're taking on a lower time frame. But if you're taking on a higher time frame, like daily time frame, technically your result and my result should be about the same. Second, right now I'm doing random weight, which is I'm doing randomized calculation. But the better way is that you implement a certain we call it as machine learning method, which I'll cover in the next topic on how to find the right settings automatically for us, the right portfolio of setting for us. Next is broker integrations. Now, this integration is like swap and spread. For the example showing just now, I am actually not taking swap and spread into consideration yet. Okay, because that will make the calculation more complex. Okay, but since it's on a daily time frame and we are holding for long term as well, spread and swap pretty much we have a way to minimize it as well. The threshold right now is a bit hard to set. Okay, that is something that you need to be aware. Like for example, a risk, that particular number in the Excel right here. This risk does not refer to any number. is something like just a KPI. It could be skewness multiplied by this, and I get the lowest is the best. It could be RI divided by skewness, I get the highest is the best. So this one is very flexible, but the number that I'm using here, which I highly recommend you guys to use it as well, which is the multiplier of skewness time with ADF. When you multiply these two together, you get, you just need to minimize the result, which is to get a minimum of minimal risk, but most consistent market. Okay. Last one is more like stationary consideration, but this is more towards whether or not this portfolio or this study will forever being good. Technically, we are running this every week, but the result will not change much. Only will change once every big market event. For example, NFP, CPI with the Federal Reserve results, as well as like elections, natural disaster when this kind of big things come out. Otherwise, this thing will not have big changes, which is very good. You don't need to have a lot of headache to change the setting all the time. You just have to run through one round, see the portfolio. If it's the same portfolio, remain and just use it. Okay. So in summarize, what we have gone through today is we have come up with a tools, a method to come up with a portfolio of forex trading. We call it as basket trading. And in fact, we're at a very earlier stage. Alpha Mascas, we have a robot called as DV6, and this DV6 robot is designed for basket trading. Okay. Looks something like this. We have a table of markets, okay, with all the market data listed here, and then you have the volatility, the scoring, the indicator, whatever lah, to do the buy and sell. But question come up, how much to buy? Which portfolio that should be emphasized on? So these are the things that the reason also why we are coming up with the Python script to do this, okay, which is to automate the right settings. And with this, that's all for today. And is there any more questions? All right, if there's no more questions, then we're going to wrap up for today's sessions. And if you guys have more technical question that you would like to ask or would like to clarify, please feel free to come to me, and I can be more specifically to tell on which part that to do whatever. Okay, first thing first, let's just make a disclaimer. I understand that this topic is extremely nerdy, okay? But trust me, this is the path of going to be automations. So I'm showing you the full flash of how or the program, what is the things that are running at the back. And basically when you're doing the study, what I'm showing you here, you are actually moving a step closer to have a proper way of thinking, a proper way of analyzing your portfolio, not just based on the indicator buy and sell, the win rate, whatever. Because when you're up to a certain level like mutual funds or index trading, right, they are not talking about win rate anymore. They don't even talk about ROI. Most of the time they talk about what is your standard deviation first, what is your ADF factors. They come all this value into a point whereby these are the exact metrics they are studying, right? Just like what I'm showing you. In fact, there are even more metrics, but these are the basic, and for me, is the most essential one. So when you study all these metrics, right, you can have a better understand. Okay, so you'll be your own fund manager. You decide which one to go in to buy how much, and when should you go out. And this is the purpose of the course, and you have the right tools and technology to help you automate this process. Okay. So with that said, that's it for today. And is there any service offering on portfolio trading or not? This is DIY. This is for you guys. So meaning that if you guys would like to have Excel, we will actually send it to you guys. Just that the reason why you guys not receiving it is because you guys should ask for it lah. So if you can ask from my team, we generate the Excel for you, and you review yourself, which are the right risk factor for yourself that you would like to invest in. you can get a specific pictures of the portfolio, maybe like this, maybe like this, and then you can just go in and do it yourself. Okay, meaning that you can open the trade yourself, but we can do the analysis all for you. Yeah. So I did not. Did you understand my? Did I answer your questions? Okay. Thank you. Okay, so with this said, that's it for today. Thank you everyone. And anything, we keep in touch. I believe that you guys have a lot of questions, not yet digest out, but feel free to come to me. That's it. Thank you everyone. Bye for now.
Lately I wanna stay awake. I don't want the days to end. I know you'll fly away. Need to hold you for myself. I feel time run through my hands. Try to grab it back, it fades. Say goodbye in all the possible ways. I don't want you to get lost. Will we ever meet again? I'll anesthetize the pain. Please remember our summer. My heart is full by jewel. Will I learn to love again? Who will walk with me through? Please remember our summer. Come the sun, come the rain, and the leaves falling. I'll wait, even if